Good morning, everybody. Good morning, everybody. Happy GDP Day. Today is Thursday, January 25th, 2024. And the top story, GDP WTF. 3.3% growth quarter over quarter for the United States GDP, blowing away expectations for 2% GDP growth. The stock market is moving vertical in an upward direction ahead of the opening bell. Is anybody thinking about the Fed and those rate cuts? Are we still talking about 7 rate cuts this year? I guess, remember the whole bad news is really good news thing? And then as soon as the good news shows up, they're like, nope, good news is good news too. Number go up no matter what. Defies belief a little bit, guys. We're going to have to get into the numbers a little. I haven't had a chance to do a real deep dive into these GDP numbers, but every category across the board is up. Every single one. Even imports was up, which is technically a negative to GDP, but literally everything went up. Nothing went down in this GDP report. Imports up, exports up, investment is up, government spending is up, consumption is up. I guess the consumption, not such a big surprise because we've been talking about BNPL, buy now, pay later loans. You know, there's rigorous background checks that they do for people with 580 credit scores, and they just let them buy stuff on a few seconds notice. Guys, these numbers really just defy logic, though. The investment numbers going up, inventories are going up, even though we've seen exports from China are way down, and we've seen new orders to our factories, and all of the manufacturing PMIs are way, way down across the nation, and yet inventories are rising. I wonder if AI is playing a role here. It's just a theory that my moderator Mish came up with this morning, and it's a pretty good one. But the GDP numbers just absolutely blowing away expectations. And now I have to ask, guys, if GDP is growing at 3.3%, if the jobs numbers are as strong as they're claiming, which they're not, but if they were, like, let's just take all the headlines. Let's not read into the reports at all. Let's just listen to the headlines. Unemployment historically low. The economy is growing so strong. Then why, oh, why would the Federal Reserve cut interest rates? They wouldn't. You don't do that in a strong, growing economy with low unemployment. You don't need to cut interest rates. So if CPI, if inflation is still above their target, if employment is still low, if GDP is still growing, there's no rate cuts then. And yet the market doesn't realize that. They're just going straight up on this news. I wonder if this rally will last through the day, or will eventually the algorithms realize, oh, crap, guys, we may want to revisit that base case of 7 rate cuts, even though the Fed said we're not thinking about cutting rates before telling us they are thinking about cutting rates, and then immediately telling us they're not cutting rates. Maybe they're cutting rates. I don't know. Flip a coin. Let's just shrink my big melon of a hedgehog. Oh, wait, no, I'm sorry. We're not shrinking yet. I got ahead of myself. The Bank Term Funding Program, the BTFP, that bailout program that wasn't a bailout, QE, not QE. Who knows? Was it really QE? The program they rolled out in March in response to the failure of Silicon Valley and Signature banks, that one is going away starting in March. A lot of people have been pointing out on this channel in the comments, hey, BTFP usage is on the rise. It reached as high as $161.5 billion. And really, banks were going to the BTFP recently, not because they were in major distress, but because they were just pigging out. It was free money. You could borrow from the Fed at 4.8% and then turn around and loan to the Fed at 5.4%. You could make free interest arbitrage. So eventually the Feds, after a few months of printing free money for the banks, they got ahead of that and they said, nope, you know what? We're getting rid of this program in March, and effective immediately, we're raising the interest rate to stop this arbitrage opportunity that the banks are taking advantage of. We also got Tesla shares are in the toilet this morning. Bad earnings from Tesla. Not really a big surprise here, guys. There's been a whole bunch of bad stories about electric vehicles recently. All of the numbers show that they're piling up at dealership, that sales were, I don't want to say sales were down because they're still growing, but they are not growing nearly as fast as they were projected. So the growth is down. Again, still nominal number rising. But the market just got ahead of itself on electric vehicles, and now they have to reprice for that. And even Tesla, even though a lot of other electric vehicle companies were really struggling, Tesla was still showing resilience. A lot of folks they didn't want an EV, they wanted a Tesla. Well, now it's actually affecting Tesla. Their earnings was a miss, and they reined in their production expectations for 2024. So bad news continues to pile up in the EV space. We got an Evergrande update today also. So much going on in the world. Now we're going to shrink my big melon of a head. And don't forget that like button, guys. It really helps with the YouTube algorithm. And if you're new to the channel, hit that subscribe button and that notification bell also while you're here, and have the coffee with the melon heads every morning. We do this every day, guys. And here we go, the S&P 500. Look at that. Here's GDP announcement. Straight up it went on that announcement. It's now, I guess, lost a little bit of that enthusiasm. But the S&P is up 0.4%, about 20 points higher ahead of the opening bell. A new record, all-time highs on a daily basis. What's the worst that could happen? Don't answer that. Dow Jones, meanwhile, is up another 88 points, or about 0.25%. Again, big move higher on the announcement of GDP at 8:30. Now, what I don't know is what is this big move down that was right around 6:30 a.m. this morning. I'm not sure what happened there. It only showed up in the Dow. It didn't show up in the S&P or the NASDAQ. We had some bad earnings yesterday from some Dow components, but there weren't really any big ones today that would impact the Dow and not the other indexes. So let me know in the comments, what was this big red candle down in the Dow around 6:30 a.m. Eastern time today? Wasn't able to find out what that one was. Meanwhile, the NASDAQ is up 90 points, or about 0.52%. Again, big green candle up with the NASDAQ on that announcement of GDP. Meanwhile, the dollar is mildly stronger this morning, 7 basis points higher at 103.31. Now, the dollar is at least starting to make the correct move on this GDP report. Initially, it was all over the place. We got a big wick on this candle. The dollar actually weakened a little bit on that GDP reading. I don't know why, because a strong GDP means a more aggressive Fed, means potentially a stronger dollar. So now the dollar is starting to rally a little bit here, only a couple of basis points. And we've actually got interest rates are heading lower on this news. Say what? 30-year Treasury down 4 basis points, 4.373. The 10-year, 4.135. That's down 4.5 basis points. The 2 years down 2.5 points, 4.353. And even the 1 month is at 5.37, down 1 point from yesterday. So interest rates are moving lower almost across the board on this. The market is seeing this GDP reading and saying dovish Fed. Someone want to point out, what does the market see that I'm missing? Because I don't see a recipe for rate cuts here. I really don't. The market begs to differ, apparently. Looking over at the commodities board, we've got February gold futures at $2,021. That's up $5.80 this morning, about 0.25% higher. Silver's up 0.5%. March silver futures trading at $23. And we have got platinum is down 1%, palladium down 1% and change. And West Texas Intermediate, this one's interesting. Crude oil is up $1.22, trading at $76.31 right now, or 1.62% higher. Crude's had a pretty good couple of days here. Check out the chart on crude oil, guys. We had this big decline starting in September. You know, demand worries were really starting to pile up. And then in October, there was a little brief signs of life in the oil market as things in the Middle East got worse and worse. That wasn't enough. The China GDP numbers were really bad, so oil went down lower again. Now it looks like we finally found a bottom right here around December 12th. That was the day that we had 3 or 4 separate attacks in the Red Sea. That was when we realized, hey, guys, the situation in the Middle East is getting a lot worse before it gets better. That was the bottom in oil, and we have very slowly started to grind higher now. We broke out of that channel here. And then yesterday, we got a big inventory drop in the oil stockpiles. EIA oil inventory shrank by 9.2 million barrels yesterday. It's a pretty big drop in oil inventories. And now on top of this news of a higher than expected GDP, I guess oil is rallying on this. So signs of life in energy markets here. That's interesting. Now let's talk about GDP, because here's the headline from the Bureau of Economic Analysis. Gross domestic product for the fourth quarter and year of 2023. Real gross domestic product increased at an annual rate of 3.3% in the fourth quarter of 2023. That's according to the advanced estimate by the Bureau of Economic Analysis. Now, guys, this is just the advanced estimate. It's going to change several times after the fact. You know, there's 2 more revisions that are going to come out. It may go up, it may go down. It's not subject to the revision shenanigans like we've seen with the jobs numbers, but it can change. That number's not carved in stone, but it's usually pretty close to the initial number when all is said and done. Now, here's a paragraph that's kind of interesting here. Increase in consumer spending. Well, let's just read this whole thing here. The increase in real GDP reflected increases in consumer spending. That's credit card debt. That's buy now, pay later loans. Exports were up. We're exporting a lot of energy now, a lot of oil, a lot of LNG, natural gas. State and local government spending was up. Non-residential fixed investment was up. Federal government spending is up. Private inventory investment is up. Residential fixed investment is up. And imports, which is a subtraction from GDP, that's up as well. First of all, let's talk about imports. How could imports be up when China, our biggest trade partner, is way down? Well, we actually get more imports, I believe, from Mexico now than we do from China. But it's not so much stuff that we're importing. I think the imports number is being shifted higher by travel. When Americans travel abroad, we're exporting dollars. Technically, that counts as an import in the GDP math. We got some airline stocks reported today. Their numbers were pretty good. So I think travel is causing the imports number to go a little bit higher. We've also seen a lot of resorts and luxury hotels are doing really well. We talked about a commercial real estate story where a luxury resort actually sold at a profit. Talked about that one yesterday. So it's possible travel is the reason why the imports are so high. Now let's look at some of these other categories here. The increase in consumer spending reflected increases in both services and goods. Within services, the leading contributors were food services and accommodations, as well as healthcare. All right, so you got a function of the traveling there, food services and accommodations. Healthcare is another big one there. That's the aging population. No surprises there. Within goods, the leading contributors to the increase were other non-durable goods led by pharmaceutical products. So again, there's that healthcare. There's that function of the aging population. An increase in pharmaceutical products is not economic prosperity. An increase in pharmaceutical products, that is, what is that? Medicine inflation? That is the aging population. So, okay, that one, that big category there, not really reflective of very good news. But we've also got recreational goods and vehicles. Now, that's interesting, vehicles, because car sales haven't really been all that strong. The car companies are actually doing pretty bad, especially after that big labor increases. But they're mentioning in this category, it was led by computer software, which I didn't know that even falls under recreational goods and vehicles. Now, that's interesting by computer software because there haven't really been any big software programs rolled out, any big new video games or anything like that. And my moderator, Mish, actually suspected on a phone call this morning, and it's a good one, that might be artificial intelligence, that maybe that is why we're seeing such big spending in recreational goods and vehicles, because software falls in that category. And, well, AI, we'd call that software, right? If people are actually spending money on artificial intelligence, I'm just theorizing here, guys. I don't have anything to support that. But otherwise, how do you explain a big increase in computer software? Now, within exports, both goods led by petroleum, that's liquefied natural gas, oil, refined chemicals, right? Remember that big reduction in oil inventory from last week? So that makes sense there. We're exporting more energy. We're still I believe we're still a net importer of energy, but we do export a lot of energy also. Services was also a big growth led by financial services. That one increased. The increase in state and local government spending primarily reflected increases in compensation of state and local government employees and investment in structures. So that's government deficit spending. That is wage inflation for government employees. Congratulations. I guess the government employees are getting the raises that the rest of us aren't. The increase in non-residential fixed investment reflected increases in intellectual property products, structures, and equipment. Now, this one was interesting because non-residential fixed investment, that's buildings, that's IPs, that's structures. Well, are we really building that many buildings outside of government buildings? I suspect the big increase here is intellectual property products. And again, I suspect that maybe we're seeing artificial intelligence playing a role there. You know, those IPs are supposedly very valuable. Are we just marking up the value of those IPs and then considering that economic growth? Well, I guess we could do that. And is that legitimate? As long as we're actually generating revenue with those intellectual properties, then yes. And see also big increases in software for the spending on recreational goods and vehicles. So maybe AI is actually starting to affect GDP here. That's interesting, guys. Now, within residential fixed investment, the increase reflected an increase of new residential structures that was partially offset by a decrease in brokers' commissions. And within imports, the increase primarily reflected an increase in services led by travel. Again, people exporting dollars, that subtracts from GDP. So, guys, we're up in every single category. Every single category of GDP is up. So are they understating the rate of inflation to make it look like economic growth? I mean, I'll be honest with you, I'm really scratching my head here. This was a huge beat in GDP. That didn't beat by just a little bit. I mean, the market was expecting 2%, and they got 3.3%. So I really got to scrutinize these numbers and open the charts and see what really drove this increase. Every single category is up here. So now I have to ask, guys, if the market is really rallying, if this rip your face off rally in the S&P 500 and the NASDAQ has been driven by the expectation that the Fed is going to cut interest rates 7 times this year, how do you explain this? How is the Fed going to cut 7 times with 3.3% economic growth? It's hard to imagine. Now, right now, the CME interest rate futures, which is basically telling us the probability of a rate cut, that is now telling us we are at a 47% likelihood of a rate cut in March. Now, that was over 80% not too long ago, but I can tell you the market has not adjusted its pricing for this lower eventuality. I mean, the odds of a rate cut in March were almost cut in half in the last couple of weeks, and yet stocks have only gone up. And if stocks were going up on the expectation of the rate cuts, then how come they don't go down on less of an expectation of a rate cut? Again, somebody's offsides here. Somebody is massively offsides here. I don't know that this reaction in the market is going to hold. The S&P is still rallying up 20 points ahead of the opening bell. Now, meanwhile, while GDP is telling us just how rip-roaring awesome this economy is, check out this article from CNBC yesterday. How much money Americans have in their savings accounts? Nearly half have less than $500. Half the country doesn't have $500. It's the best economy ever, everybody. Nearly half of Americans have $500 or less in their savings accounts, an amount that leaves them vulnerable to unexpected expenses, according to Go Banking Rate's survey of 1,063 U.S. adults conducted in November of 2023. About 29% of respondents have between $500 and $5,000 in their savings accounts, while the remaining 21% of Americans have $5,000 or more. Few hold much cash in their checking accounts as well. Of those surveyed, 60% report having $500 or less in their checking accounts, while only about 12% have $2,000 or more. Everybody's broke. Where is this GDP growth coming from? More than half the country doesn't have $500, and yet consumer spending is up. Why? Debt. Credit cards and buy now, pay later loans. They're juicing these numbers. As long as the gravy train keeps up, as long as the banks are willing to lend to people with no money and lousy credit, I guess these numbers are going to keep up. The debt pile keeps getting bigger. Eventually, that bill does come due, right? I mean, we do have a debt-based economy, so I'm assuming in our debt-based economy, eventually we pay our debts. Maybe the joke's on me, the idea of paying debts. Maybe I'm just antiquated, and the concept of actually paying debts is old-fashioned. Anyways, Fed to allow emergency bank lending program to expire on March 11th. This one just hit the tape late last night. Bye-bye BTFP. The Federal Reserve on Wednesday said a funding lifeline created for banks last year after the collapse of Silicon Valley Bank threatened to spark a wider financial crisis, and that would close as scheduled in March. The Fed will also immediately raise the interest rate on new loans from the Bank Term Funding Program for the remainder of its life, effectively ending what had become a popular and profitable arbitrage opportunity for U.S. lenders. So the BTFP is going away, guys. This is the chart of the Bank Term Funding Program going all the way back to when it was rolled out in March here. This is on the St. Louis Fed website. Now, this initial run up here and this slight creep up, this was actual banks needing the lifeline from the Fed. They would park their assets at the Federal Reserve, assets that were not worth as much money as they were borrowing against them. And that would cost them about 5% interest. Now, the interest on the BTFP eventually went down a little bit, even though the interest on overnight balances at the Fed on reserves went up. And so banks realized, hey, we can go to the BTFP with assets that aren't worth very much money. We can borrow par value of those assets. Then we could turn around and we could lend that par value right back to the Federal Reserve and earn more interest rate than we're paying on that borrowed money. And one by one, the banks realized, hey, they're giving away free money. We might as well take it. And that's when the BTFP went from about 109 billion and it shot up to 161.5. Finally, the Fed, slow to react, has said enough of this. Effective immediately, the interest rates are going up, so that arbitrage opportunity is going away. This number should stop climbing. And then in March, the program is going away entirely. Now, I would add, guys, when the program goes away, that means they won't be issuing any new loans. The existing loans will stay. So some of these initial loans from last March will probably start to get paid back. I believe it was a one-year term was attached to these things. But these recent loans that were taken out in the last couple of months, those are going to be there for another year still. So this isn't going to go to zero right away, but it is going to start dropping off. Speaking of banks and bank runs, check out this one from the European Central Bank. ECB asks some lenders to monitor social media for early signs of bank runs. ECB, the central banks, they want to monitor social media. Do you think this is about the health of the banks, or do you think this is about shutting you up if you think there might be a problem in the banking system? Again, for your own good, of course. Check this one out. The European Central Bank has asked some banks to closely monitor activity on social media to detect a worsening sentiment, which could lead to a deposit run. Two banking executives with knowledge of the request told Reuters. European regulators have sharpened scrutiny of banks' liquidity after the collapse of Silicon Valley and Credit Suisse in March of last year, the people said, requesting anonymity because the discussions are private. Banks can run into financial trouble if clients rush to pull deposits at the same time. In October of 2022, a social media post from a journalist saying that a major international investment bank is on the brink led to a run on Credit Suisse, with clients withdrawing more than 100 billion Swiss francs, which is about $116 billion US, by the end of the fourth quarter of that year. Are these regulators really saying the reason Credit Suisse failed was because a journalist tweeted something? Is that what they're telling us? Oh, Credit Suisse didn't fail because they lost tens of billions of dollars of their investors' money on Greensill and on Archegos because their risk management people are idiots. No, they didn't lose a bunch of money because they bought interest bonds at interest rates of near 0%. When interest rates started to rise, they lost money. No, Credit Suisse failed because of Twitter, because of social media. That's why. And so naturally, the solution isn't to run better banks to prevent bank runs. No, the solution is to monitor social media. Well, what are you going to do with that monitoring? What they're going to do is they're going to call up the social media companies and they're going to say, we want you to shut up this guy. He's pointing out a problem with our banks. People don't have a right to know. Their financial system is run by greedy a-holes. So we want you to throttle the exposure on this account. That is what this story is about. The speed at which clients yank deposits has triggered a debate globally on whether, under the current regulation, institutions can withstand sudden liquidity shocks and whether new rules might be needed. Now, keep in mind, guys, as these globalist, tyrannical, capital T, they, a-holes start to push central bank digital currencies by telling you it's so efficient and so speedy and we can do instant transactions and it's new technology. At the same time, they're telling you that is such a great idea. They're also saying it's too easy for you to move your money, so we need new rules to slow down the peasants from withdrawing their money when they finally find out that we've run their banks into the toilet with our own greed. And so the solution, again, it's the solution to the bank runs. It's not run better banks. It's shut people up. It's limit people's ability to withdraw their money. It's close the doors and lock people below decks on the Titanic. That's the solution that they're proposing. This story really had me grinding my teeth yesterday. Meanwhile, Tesla, EV collapse continues. Tesla stock drops on Q4 earnings miss. Warns production growth rate will be notably lower than 2023. CEO Elon Musk did say that the company's next-gen vehicle will be coming in the second half of 2025. Tesla reported Q4 earnings that missed estimates and issued a downbeat full-year production outlook that weighed on the stock. Though CEO Elon Musk did confirm that the company's next-gen vehicle will be coming in the second half of 25. For the fourth quarter, Tesla reported top-line revenue of $25.17 billion. That's versus $25.87 billion estimated. However, revenue rose approximately 3% from a year ago. 3% revenue rise, guys, that is barely keeping pace with inflation. And keep in mind, Tesla sold a lot more vehicles than a year ago. So those price cuts starting to squeeze the margins. We're starting to see at Tesla. From a profitability standpoint, Tesla reported EPS of 71 cents. That's adjusted EPS, by the way, versus 73 cents expected, and adjusted net income of 2.486 billion versus 2.61 billion expected by the streets. So these numbers are a miss across the board for Tesla. In terms of its full year production, Tesla said its vehicle volume growth rate may be notably lower than the growth rate achieved in 2023 as our teams work on the launch of the next generation vehicle at Gigafactory Texas, indicating it would not reach street estimates of 2.19 million vehicles for 2024, which would have been a 21% increase from 2023. So they're making less money on their vehicles as they lower prices, and it looks like they're saying their full year production, that their growth rate won't be as much as 2023. Now, keep in mind, that's the growth rate, so they will still sell more cars, just not as many more as people were expecting. So when you're talking about EVs, that's important, guys. Yes, EVs are still growing, but they are growing nowhere near as much as they should be growing, especially considering how heavily we subsidize electric vehicles. Now, Tesla stock is taking it on the jaw this morning. Tesla is currently trading at $189.50, down $18 or almost 9%, about 8.7% lower for Tesla ahead of the opening bell. And again, guys, Tesla was one of the rare exceptions to this EV, I don't want to say EV apocalypse. Again, they're still growing. They're just not growing that much. It was the Chevy, it was the Ford electric vehicles that were having problems. Demand for Teslas was still pretty strong, at least right up until now. Those earnings not looking so good for Tesla. Now let's talk about China real quick, guys. Exclusive China Evergrande offshore bondholder group to join liquidation petition. We were talking about this one on my Patreon Zoom yesterday. This one just quietly was snuck in there. Want to read a little bit here. A key offshore bondholder group of China Evergrande plans to join a petition to liquidate the developer at a hearing in a Hong Kong court on Monday, just 4 days from now. Two sources with the direct knowledge said. The bondholder group owns more than $2 billion in offshore notes guaranteed by Evergrande, and its support to a winding up petition, i.e. liquidation, against the world's most indebted developer could increase the chances of an immediate liquidation order from the court, lawyers in the industry said. So the offshore bondholders, the people, the non-Chinese owners of Evergrande debt or owners of dollar-denominated Evergrande debt, these were the guys who were on the side of let's restructure, let's not just liquidate the company. I think we can work something out. They were the biggest group that was supporting not liquidating Evergrande. And that's the reason why the decision was delayed by several months back in November. Well, that decision is coming up again on Monday, January 29th. We're going to find out. It's scheduled for the next hearing, which is supposedly going to be the last hearing this time. I swear. No, really, guys, I'm serious this time because they keep pushing this decision out over and over again. Well, at the last hearing, the offshore bondholders said, we want one more chance to work out a deal. So they delayed the decision. Well, now the offshore bondholders are telling the judge, no deal, sell everything, liquidate it all. Now, this could be catastrophic for China because this means price discovery. If Evergrande gets wound up or if they liquidate the company, all those buildings, all those construction assets, everything just gets sold and we find out what it's really worth. And there's no buyers, guys, which means the price is going to go down a lot lower. And well, remember, real estate is all based on comps. So if all these buildings sell for pennies on the dollar, that means all the other developers are going to have to revalue their assets based on what those comps are selling for. So this could lead to a cascade of additional failures in China's developer industry, which could very quickly spread to China's banking system, which has already almost happened a few times. And this would happen right in the middle of a massive sell-off in the Chinese stock market. So this could come at a really bad time. I wouldn't be surprised to see one more delay from that Hong Kong court on this wind-up petition. We'll know on Monday. But if Evergrande goes into liquidation while this stock market sell-off is still happening, forget it. All hell's going to break loose in China. This would be very bad. Now, speaking of that stock market sell-off, we had a rip and rally in Chinese stocks yesterday, again, on the back heels of all this stimulus, the national team, i.e. the Chinese government directly buying stocks, banning institutions from shorting index futures, banning retail traders from shorting stocks, any institutions that sell too many stocks, getting visits from the secret police, all these wonderful things. Well, That gave us 3 up days in the stock market. 1, 2, 3 green candles. Yesterday, the SSE, that's the Shanghai Stock Exchange, the SSE Composite was up 3% yesterday. So 3 green candles in a row for China. Maybe all these stimmies are finally starting to work a little bit. And Hong Kong, the Hang Seng Index, that one was also looking pretty good yesterday, up 1.96, almost 2%. Again, 3 green candles for the Hang Seng. So signs of life in the Chinese stock market, maybe, but Evergrande coming up on Monday may torpedo this nascent rally in Chinese stocks on the heels of all of this stimulus. So, guys, I told you there is a lot happening in the world today. Plenty going on here. GDP growing like gangbusters. Tesla stock, their earnings stinks. The BTFP is going away. China, signs of life, but Evergrande's going to ruin that. So much going on. And I just want to say thank you very much to Nashville Pasta Man. He says GDP is so awesome. Noom just laid off 20% of its workforce. You know, I'm hearing more and more stories, more anecdotes about these layoffs. Also came up on my Patreon call yesterday. Ford may be offering buyouts to employees pretty soon. We haven't heard about that one just yet. But remember, those big UAW contracts, that big raise, and immediately go right into job cuts. We're seeing a lot of these stories about layoffs. Big tech layoffs happens in January. That's 2 years in a row. But we're starting to see it more in retailers too. Noom, I'm not familiar with that one, Nashville Pasta Man. I don't know about that computer, but 20% of their workforce, you know, we've seen that headline before. We're seeing that all across the economy. But the jobs numbers still look good somehow. I don't know how, but somehow the jobs numbers still look good. The headlines, we'll just revise them later. And then somehow, despite all of the factory orders being in the toilet and the manufacturing PMIs being negative for more than a year, we're still getting inventory growth in GDP. I guess people are just saying, well, our artificial intelligence IP is worth more money, and therefore our inventory has gone up. Maybe that's it. Defies reality, this GDP growth, guys. And that number beat by such a huge margin. I hope somebody is going to start scrutinizing this data a little bit more. Somebody besides me. Somebody open the report, read the numbers, and see what's in there. I can't be the only one doing that. I know there's other channels that are doing that too, but nobody in the mainstream press is looking, especially after that jobs number we got last month. Nobody in the mainstream press opened that up and said, whoa, guys, 1.5 million full-time jobs disappeared, 700,000 part-time jobs replacing them. That's a big loss. Whoa, 200,000 people getting new or second jobs. Like, nobody in the mainstream press was talking about that. All they said was, 216,000 jobs added. Never mind 70,000 downward revisions. So it's the same thing with GDP. Where is the growth coming from? Let me know in the comments, guys. Where do you think the growth is coming from? Is it all AI? Are we really am I just undervaluing just how awesome AI is going to be? I know I've been very critical of AI. Look, I think AI is a bubble, AI mania. That doesn't mean the technology is a bubble. It means the companies are a bubble. I draw the parallels to the dot-coms a lot, right? The internet didn't go away when the dot-com bubble burst, but that wasn't enough to save the companies. The technology survived. The companies were just overinflated, and anybody who said .com was given $1 billion valuation when really there was no substance behind those companies. I see something similar going on with AI, but hey, maybe I'm wrong about that. It's one possible explanation for these GDP numbers. Thank you very much, Nashville Pasta Man. Appreciate the super chat, sir, and the support of the channel. And thank you to the gray man who says the definition of reverse market crash seems to be more applicable as time goes by. We are absolutely watching a melt up in the stock market right now. The VIX is being suppressed. The 0-day to expiration options, algorithms are driving it. The Mag 7 steering most of it. And yet, once you walk back, leave the headlines, actually look at what's going on in the economy, you end up, gray man, with stories like Pasta Man's 20% of the workforce getting laid off, with manufacturing PMIs going way down, with China's economy in the toilet because there's no exports and consumerism is down in China. And then, of course, you peel a little bit further and you see, oh, wow, buy now, pay later debt is supporting consumer spending along with $1 trillion in credit card. That's not organic growth. That's just future pain that we haven't felt yet. On top of that, you've got private equity. That video I did earlier this week about how these privately held companies are not worth what they're claiming they're worth because interest rates have risen, and they're just borrowing money against those assets to try to keep that charade going a little longer until hopefully the Fed cuts rates. Well, with 3% GDP growth, the Fed ain't going to be cutting rates in March. I can tell you that. So, yeah, the melt up continues, gray man. How high can it go? Still $600 billion in the reverse repo, so there's still more liquidity. It can go higher. Thank you very much, sir, for the super chat, the support of the channel. And thank you, Steve Woitis. Says, my grocery store had a month-long strike in the summer, now doing renovations to install more automated checkout lines. Oh, we have seen that story play out over and over, haven't we? We get strikes, we get minimum wage laws, increases, and what ends up happening? The people that those efforts were meant to help end up being the ones who suffer for it. The business owners don't take fewer profits. The business owners don't go out of business. They innovate and they replace workers. We've seen that in fast food. Now we're seeing that in automated checkout lines. And by the way, it drives me absolutely nuts when I go to check out at the store and there are 20 freaking checkout registers and there's only one with an actual human being working at them. All the other ones, the lights are turned off. And then there's a line a mile long at the self-checkout while everybody tries to figure out how to go beep, goop, beep. I'm sorry. Put your thing in the baggage area. My stupid sensor didn't register the 0.5 gram weight of that light of this feather product that you just paid for and then put in the bagging area. And so I'm going to freeze this whole freaking process and make everybody behind you's day miserable until somebody comes over with their little lanyard on the string thingy around their neck and goes beep and enters their code and then types in a bunch of numbers. You have no idea what they're doing and what it's going to cost you and if you're overpaying or not. But whatever, I'll overpay because the people behind me are ready to kill me if I don't get out of here soon. Time to scan something else. Beep. Please wait. Please hold for attention. Good God. Put a human being behind the register. Sorry, man. I really went off. That was tangential. I didn't mean to go so tangential. Anyways, thank you, Steve Woitis, for whatever the heck that was. I appreciate the super chat, the support of the channel. Thank you, everybody, for having your coffee with the melon heads this morning. Thank you to my Patreon supporters for everything you guys do for the channel. You guys are awesome. I appreciate it very much. Also, hi, Mom. Hi, Dad. I love you guys and everybody. Until next time, live small and dream big.